Something doesn't add up here, people. Something does not add up. Something's a little fishy. Take a look at this. Side-by-side comparison. HYG, which is high yield corporate bond. Below us is the S&P 500 here. This is a 5-minute chart for the last 4 trading days. That's week to date. And as you can see here, there's a very tight correlation. But where it breaks off is really today. The S&P 500 ripped up higher at around 1 o'clock. Meanwhile, HYG, where smart money trades, it did not participate in that rally. So how do we interpret this? I don't quite know, but we are going to hop into a few different things to really help clarify where the market's kind of mind might be at. We're going to also go into opportunities that I see at the end of the video, and we're also going to talk about Bitcoin and Ethereum, what's going on over there. Got an action-packed episode. You're watching the Stock Market Brief Show. Thank you for all the thumbs up yesterday. Go ahead and smash that thumbs up button and subscribe to the channel if you haven't done so already. It's greatly appreciated. I'm almost at 100K. Help me get there. Let's go ahead and get into today's episode. All right, everybody, welcome back. We are going to look at HYG here, and you're going to see 2 blue lines across the screen. What are these blue lines? These are the options expected move for the week. So it was weird to me that it wasn't participating in this rally, and you have smart money trade bonds. So the fact that HYG did not participate, albeit a very short period of time, it has working hand in hand this entire week, but it is a little concerning. Now, when I look at the weekly expected move, it is actually outside of it. And when it gets outside of it, you could see future or further volatility if it keeps on moving outside of it. However, 68% of the time, you do ending up within that expected move range. So this is something that I just wanted to point out. We have only one more trading day left in this week. So is it going to be calm overall? Is the market going to potentially rally, or is it going to just kind of skirt along the line of this expected move for the week? Well, let's take a look at the S&P 500. The S&P 500, if you remember yesterday, one of the things that I had stated was this is not exactly the area where you want to really push short. Now, you probably think if you heard that and you were watching the stock market in the first hour, 2 hours of trading or whatever it may be, you'd be like, well, he was wrong because the market kept on pressing down after a gap down. However, very, to our surprise here, middle of the day, the market began to really rally. And you could see that in a lot of lower time frame charts. At the, for example, the IWM, I'll show you on the 15-minute time frame exactly where I found the bottom, just to kind of give you an idea and some insight into that. But where's the S&P 500 now? Well, we're not too far off the lower risk range. So is it possible that we come right back down to the safety zone? I mean, 68% of the time we end up in this, and it looks like we're going to end up in it unless we get some insane news that happens tomorrow that can really get us to the outside or push us way to the upside, which would be insane if we finished to the upside of all of that. I'm not going to expect that to happen. Keep in mind here, we came up, we tried to fill that gap right over there. Looks like it was successful on this time frame, and then we found some resistance. So if we get above the high of this candle for the day, I think that offers up some opportunity to potentially push higher to give us a higher high and a higher low. Okay, as far as downside risk tomorrow, I think it's more than possible to come back right back down to this lower risk range. So be mindful of that. And the reason why I say be mindful of that is because if you look at the lower time frames, where was the risk range? It was at just over 445. If you take a look at 445, which is right here, 445, right above it, this whole area right here, which is, the entire week of trading, it's been just skirting along that lower risk range just up until recently. And then when it burst out to the upside today, look where it hit, a declining 5-day moving average. You can see it right here, darn near perfectly, okay? So now we're starting to see, let me point it out, lower, boom, 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 lower highs and lower lows. Now, one could look at this also and say, well, it's actually flagging, and that's also a big possibility there too. So we cannot rule that out. As it stands right now, the 5-day moving average is declining, and if you take a look here, it got, perfectly rejected. We have the risk range just below us, so, it's going to be probably a wacky and wild Friday. I'm not much of a trader on Fridays. If you like to enjoy your weekends, you typically got to just not do anything crazy on a Friday, that is. Now, are we risk on or are we risk off? This is where it gets a little more interesting, right? It has been more of a defensive type lean this last week. So healthcare, consumer staples up there, those are more defensive type sectors. And those were also some of the top performing sectors. You had energy also up there. If you just take a look at the relative strength line, you can see here healthcare is hitting new highs, and healthcare's relative strength line is just dominating as it stands right now. You have defensive names moving up higher relative to the SPY. You have XLP higher than the SPY. Utilities kind of downticked, and gold also is skirting the line right here, but it looks like there's some opportunity, which we talked about in yesterday's video, that along with silver. Now, what isn't really the right risk on off behavior is TLT. TLT is just, the bond market has just been completely volatile. So that is going to be one to watch in a more risk-off environment if that correlation is still going to hold. If you take a look at what happened to the Qs today, very similar situation. It came all the way down to the 50-day moving average, tagged it. Where do we close? We close right back in the expected move range. So it's been pinging-ponging back and forth for multiple days. If you look at the 15-minute time frame here, take a look. We're talking about this volume profile. And we said, don't be too surprised, and we did this for the IWM too, if it just comes back and acts like a magnet here. And you can see it ripped up and then it pulled right back into this area. Okay, so as it stands right now, where are we? Well, we're underneath a declining 5-day moving average. So be mindful of that. We have a gap above us too, and that can act as resistance. And you pair that with confluence with the 5-day moving average as well. So that could spell out still trouble on a Friday. So do not rule it out. When you look at this chart, what do you see? When I look at this chart, I just see price action going sideways, right? Hits the upper end of the range, comes to the down, comes to the upper range, comes right back down to the middle. Can it come back down and test these levels? I mean, don't rule it out, right? However, there are some interesting things taking place, and I'll pull that chart up here momentarily. But first, let's look at the IWM. The IWM is outside of the risk range. So if we are going to get some sort of rally, and this does end up finishing within the risk range here, the opportunity would be here. Is it going to do so? Well, it looked very scary earlier in the day, but then it started catching a bid. It is still below that 50-day moving average. So, in my opinion, if we start taking out the high of today, and the high of today was 201.23, I think that goes back into the risk range. Now, if I look at the 15-minute time frame, I said, I'll show you how did I mark a bottom today. First and foremost, before I actually tell you how I marked the bottom, or how I didn't, how do I word this? No, I didn't mark this specific bottom, but it looked like an opportunity. And if your eye is trained to see this, you can potentially find these type of moves as well. Because this market, you have to be very tactical. But where do we end up? Well, take a look, right? Remember this volume shelf profile? And it's been chopping around, and we came all the way up, and we said, hey, don't be too shocked if we come right back down right here to this point of control. Look where we came. Boom, boom, boom. Pulled right back into it like a magnet itself. Now, how did we know that there's going to be some sort of a rally? Well, we didn't know for certainty, but what we did see was a very aggressive move to the downside. Bam, straight down. We had a positive divergence, so that tells me that the momentum to the downside is weakening. And then we saw this hammer candle right here forming. That little hammer candle shows me that the bulls stepped in right at 196.75. So if that high was taken out, that could offer up a potential pop. Now, how high that pop goes, I don't know, but the trade itself offered up a good risk to reward. And as you can see here, pop, 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 it started moving a lot higher, which made for a good intraday trade. Now, where do we stand as it stands right now? We are still in a trading range below a declining 5-day moving average. So you still need to hold your guard up. Now, when I talked about potential opportunity, well, we're going to talk about more specific to the opportunity more towards the end of the show. But the NASDAQ composite, I need to call it out. I know people are going to call it out. I even posted on Twitter a week and a half ago, 2 weeks ago. At some point, very soon, people are going to start talking about inverse head and shoulders. I think the time is here. I think we're probably hearing more people talking about it. But you have a left shoulder, you have a head, and you have a right shoulder building out. You had a positive divergence on the stochastics, positive divergence on the on the RSI. This is the 60-minute chart of the NASDAQ composite. So what do we want to see? Well, we want to see, to feel more confident that we can see some more further upside, you need price to get back above 14,600, perhaps even a back test, show that it is actually holding, and this thing could have a big time move. So do you want to jump in early? Maybe, right? But you need to manage your risk if you do that. To get confirmation that we could see further upside, how do I word this? I'd say it's not about where what price you buy at. it's if you bought it at the right or wrong price. And buying here, expecting that it's going to come up here, but it keeps going down, or maybe it comes up and then goes down like this and you're still holding the bag, that can get dangerous. So waiting for confirmations are always a very positive thing. Even if you're buying it at a higher level, it's all about managing your risk, right? You want better risk to reward. You want to risk less to potentially get more. And the trades right here, unfortunately, you might be able to catch it right to the upside and have a little stop loss down here if you're looking at like the Qs or something. But just be mindful that the price is all over the place. Price hasn't tightened up. So if price isn't tightening up, that means you're walking into an expanded type of move. So you need to be very tactical at picking out key levels. Now, another thing that's kind of been on my mind here is taking a look at the Summation Index. And the Summation Index you can see here is curling over. So if that doesn't repair itself, we're going to have the SAR cross back above it. And we might not get back above zero then, which signals to me, oh, wait, shoot, there might be some more potential downside in this swing, bringing the market back down with it. So we'll see how that follows up. I will let you know when the SAR clicks above it or if it clicks above it, because it might not happen right now. Okay, but I'll keep that on deck. Also, the dollar continues to find some strength. It's been on a 1, 2, 3, 4, 5, 6 day tear here, and it's you can see the Bollinger Bands. They were tight. Now they're starting to expand. Right, contraction leads to expansion. I would imagine that we can potentially get a back test at some point and then see if the strength holds. But as it stands right now, when can we get a back test? I don't know. If you look at a chart of utilities, right? Utilities went like this and it just went like boom, and we barely even got a pullback. So yeah, it could very well go higher, and that could put pressure on various commodities as well as the markets. Oil also wide range today. Once again, not as big as yesterday's, and it finished slightly down on the day, and it's still below that 50 period moving average. So is this going to be a little head fake? Boom, boom. Well, we're going to talk about partially this in that opportunity section of the show, okay? So we're going to be keeping a close eye there, and I'm going to just dive into a couple individual equities. If we take a look at the advanced decline line, bullish or bearish, you need to pay attention to what's going on here, okay? The NYA, the New York Stock Exchange, is good to look at because it's a good broad view of the market. So what's the broad view telling me right now? Well, the broad view is telling me that price hasn't gone anywhere since May of last year. And the broad view is telling me that we're putting in higher lows and higher highs. You see these red lines here? Boom, ba-boom, boom, bakim, batim, boom. Those are lower highs and higher lows. Wait, lower highs and lower lows, okay? And it's just a violent chop back and forth. So to see this go up, down, up, would you be surprised to see it go down further? Now, it did form a nice hammer candle. Meanwhile, if you pair this with the advanced decline line, you can see here the advanced decline line is, way under, where it was over here. Vice versa, if you take a look at the New York Stock Exchange, price action, the price, is above these key levels over here. So it tells me that the broad market's holding up at these levels. However, the internals are still damaged. They're still weak. So it's going to take a lot to repair this. Not say it's impossible, but it's going to take a lot to repair it. So you need to pay attention to what this market is telling you. Now it's time to hop into some crypto. This is the Sailor to Shift tool. Okay, Sailor to Shift tool is starting to curl itself over. We are seeing some weakening in the price of Bitcoin. This could very well be a evening star type candlestick pattern. We have one more day left. However, when we go to the daily time frames, it doesn't look all too bad. So let's go ahead and do that. All right, so we're looking at Bitcoin on the daily time frame here at ftx.us. For those that don't know what this website is, FTX is a trading platform. They sponsor me. This is the platform that I personally use as well. I trade on ftx.us. You can trade crypto here with up to 85% lower fees than the competitors. And on here, you have access to TradingView. You can set up your charts and you can buy and sell right from the website. I think it's pretty cool. Let's hop into the analysis here of Bitcoin. The reason why I said that it might not be, too bad to see this, it's still early, But really what we're seeing here is we're just seeing price action back test. So this is actually a very positive thing to see. A back test, now we need to see if we can see some strength. So actually the new daily candle just formed. As you can see, it actually just clicked over right here. But right now, if we get some continued strength or get above the high of the previous daily candle, which is about 43,840, that might push us up higher. Now, the Bitcoin, the Sailor to Shift ratio, it started to turn. That makes sense, but it hasn't flipped over to a sell signal yet. So until that does, is when I would get out of that specific position. And as it stands right now, I'm still holding strong. A couple of concerns here, right? The MACD is starting to curl itself over on this big down day, which I'm sure everyone was aware of. If I zoom in here, okay, this day right here, this big down day, that right there came on increasing volume too, which is not necessarily a great thing. So there might spell some more downside. If we do get a little bit more downside, this 50-day moving average right around 42,000 would be the level of support that I would want. I would want bare minimum for that to hold and then see some strength come from that. All right, let's go take a look at Ethereum here. 1 second. All righty. So Ethereum, a very similar situation. I don't have the lines drawn out, but that's okay. I'll draw them really quickly here. So if you take a look, Ethereum also broke out very similar to Bitcoin. And as you can see, it hasn't actually even back tested yet. So this to me signals that, hey, we still can potentially have further downside, maybe around 3,000 to get a proper back test. Now, if you're looking at it like this, that's one thing, but you can also potentially look at it like so. So it is potentially broke out of this area. Previous resistance might hold as support. My thought is if it does break down further, start looking at that 50-day moving average. Of note, the MACD, if you zoom in here, it is starting to cross over, so bearish crossover. RSI is still above that 50 marker as it stands. On the way down here too, we had some increasing volume. So that's not the greatest sign, but it's still too early to tell at this particular point in time. And in my personal opinion, if the signal hasn't flipped over yet, I'm waiting for that signal to flip. That's how I trade this specific strategy. Let's go ahead now and hop back to another opportunity that I'm seeing in the markets. All right, energy. This is where the opportunity, I think, is, and we're going to dive into this a little bit deeper and show you the top holdings in XLE. Now, why do I think this is a potential opportunity? I'm not speaking from a bearish or bullish perspective here. I'm talking from a risk management perspective. Okay, just like I talked about silver yesterday and the miners, I want to talk about this specifically from a risk to reward standpoint. The reason why I'm talking from a risk to reward standpoint is not many people right now, well, I mean, if you're part of the finance type of community, they probably are talking about it because it's been the top performing thing. But because nothing's running right now, it's not hitting headlines, right, for the most part, other than very expensive gas, I guess. But besides the point, risk to reward is very important here. And what do I mean by that? Well, when you have contracting price action and you see price break out, it allows you to have a tighter stop loss, which means that if it comes out and breaks down, you can stop out for a lower dollar amount per share. All right. Whereas if price action's loose and wild, you need to try to tag tops and tag bottoms to have a better risk to reward. So me personally, when I look at this chart, it is in bullish context. Albeit that energy and oil, it's all over the place and we can probably see some whipsaws. But from a risk management perspective here, this is looking quite good from a bearish and or bullish perspective, right? If it breaks down, you might be able to play a trade down lower. Just note that it's in the context, you'd be swimming up a creek if you were shorting down into this. And you could get very successful there. But besides the point, price action is getting very tight. Let's hop in to the top holdings of XLE. Get to learn something here. So the big holdings, XOM and CVX. So if those go down, chances are the energy sector, XLE, it's going to go down too. All right. So we're going to look at these charts as well as these charts to determine what might be some good opportunities here and see how price action is looking. Let's hop into the first one, XOM. Just look at this thing. This is known, what Mark Minervini terms this as a volatility contraction pattern. But really, honestly, all patterns, for the most part, contract. Volatility contracts in most patterns, whether it's bull flags, bull pennants, ascending triangles. You typically wait for volatility to contract, you back into the trade, have tighter risk, and then you have volatility expand in your favor. What do we see here? Well, XOM pulled back, came up, pulled back, and now price is just winding up tight. Now, what would be nice to see is a breakout above 85 with some increased volume to support the move. You have a bullish crossover on the MACD, and you can see the relative strength line between XOM and the S&P 500 start to fire off there too. This, to me, I mean, it's a no-brainer, really. So this is why I say it's a no-brainer. It doesn't matter if you don't make money on this trade, because from a risk management perspective, even if you got stopped, if it went out and stopped you out, it still made sense, right? Because no matter how long you trade or how long you've been trading, you don't need to be right 100% of the time to make money. You just need to find good setups like this, right? And be right 50% of the time. If you're right 50% of the time and you're managing risk this type, but yet you're catching reward to the upside, you're going to make money, right? You just need to be able to really manage that risk. Okay, so XOM is right there. Take a look at CVX. This is one that I did just recently post onto my Discord. CVX, this thing is getting wound up so darn tight. Now, look at the volume here too. This is awesome. Volume on the way up, explosive. Now, it's been consolidating and volume is getting almost just bare minimum, right? You haven't seen this low of volume for quite some time. So other times, right, it was contracting here. See how how these days kind of came down in? Let me remove that. See how price action got really tight here? Started flagging. Volume was drying and getting almost minimal. And then all of a sudden, pow, it broke up with some stronger volume. Look at the leg that led. Boom. All right, we're seeing something here too now take place. Now, is it going to be as successful as this move? I couldn't tell you. You know, the farther that the moves go, you'll notice that the price action at later stage bases, they get looser and looser. So right now, I mean, if it breaks out, you can have a very tight stop loss. And hey, if we're lucky, this might catch a whole nother leg higher. It could go up to $200. It could potentially go higher. How do you measure a full measured move? You can measure from the bottom of the pole to the top, right? That's, 130 to 175. I'm not quick with math, but 45 points. So if it goes up from here, breakout, and you have this tight of risk, and it goes up $45 per share, that's pretty crazy. I think I did my 40, 50, 60, yeah, $40. Yeah, wouldn't that be crazy? Sheesh. Let's take a look at EOG. EOG also volume getting tight. It's getting a little bit of traction right here, but overall very tight, right? We had this big move in volume right there. You can see boom, 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 higher lows. And it's just been putting in lower highs right here, but price action is getting very tight where if this starts breaking out, it's above that 20-day, you can have a stop below it, and then it might just press up very quickly to around 125. And then you can potentially take a little bit of profits on the table, or if it takes out that level, it might head higher. Okay, so right now as it stands, CVX is looking pretty good. All of these are good. COP is another one. Look at this little wedge right here. It's below that 20-day moving average. So if it starts getting back above it, I think that this meets the requirement for what's called a Holy Grail trade. Linda Rashiki, if I'm pronouncing that correctly, she created the Holy Grail in a book, I believe it was called Street Smarts, a long time ago. And it's when the price, it's actually the EMA, the 20 period, but it's besides the point. But you can see here, it pulls down to the 20, comes up, pulls down, got under the 20. If you waited for it to go, bam, took out that high. Came out underneath it, bam, took out that high. So really how you play it is if it gets back above the 20, you play it to the previous high, which would take us from 100 to around 107, 107.50, which is $7 per share. So that to me is a good opportunity, and you're risking pretty much nothing here. You can put a stop below the 50-day moving average, and you're, it's a few bucks here, to potentially catch a move all the way up here. Those are the opportunities I'm seeing. Like, I'm not confident that these are going to just blow off to the upside, but I am confident that they do have a very good risk to reward. That's all I got for you on today's episode, everybody. Hope it helped out. See you all back on the next one.